Welcome to Learn Wealth, your go-to channel for real estate insights, market charts, and golden opportunity. Let's build wealth together.
How's it going, everyone? My name is James Santiago, and you're watching your show, Learn Wealthy. The Federal Reserve's Beige book is out. What is this Beige book? So, the Federal Reserve's Beige book is a report published 8 times a year by the Federal Reserve's board. It provides a summary of economic conditions across the 12 Federal Reserve's district in the United States. The information is gathered through interviews with business leaders, economists, and other contacts in each district. And it includes observations on economic activity, employment, wages, and prices. The Beige book is used by the Federal Open Market Committee, or FOMC, to help inform its monetary policy decisions. It offers a snapshot of current economic conditions and trends, complementing other data and reports that the Fed views. So the Beige book came out yesterday, September 4, and we're gonna go over the summary of it, if it aligns with our base case here at Learn Wealthy. If you've been watching and following this channel, you know our base case here is that we are headed for a recession. Not a soft landing, but the bad kind of recession. If you have not been watching this channel, make sure you subscribe to know the latest trend in macroeconomics and real estate. So let's go to the Federal Reserve's website and onto the Beige book. So we're at the Federal Reserve's website, as you can see here. Sorry, this is covering that. federalreserves.gov. I'll put the whole link on the description below. And we're here at the Beige book. As you can see, there's 2024. You can read it by came out yesterday, September 4. You can read it as HTML or PDF. Let's go via PDF. The Beige book, as you can see, it's color beige. Yeah, so the purpose of this is intended to characterize the change in economic conditions since the last report. We got last report on not too long ago, July 17. Outreach for the Beige book is one of many ways the Federal Reserve System engages with business and other organizations about economic development in their community. Because this information is collected from a wide range of contacts through a variety of formal and informal methods, the Beige book can complement other forms of regional information gathering. The Beige book is not a commentary on the views of Federal Reserve officials. At least that's what they say. Let's go to the summary. There's a summary here somewhere. National summary. Overall economic activity. Economic activity grew slightly in 3 districts, while the number of districts that reported flat or declining activity rose from 5 in the prior period to 9, while the growing districts was 3. Employment levels were steady overall, though there were isolated reports that firms filled only necessary positions, reduced hours and shifts, or lowered overall employment level through attrition. That's BS. I'll show you some chart later why I think employment is not doing so well. We are going to have the BLS employment report tomorrow. And remember that last month's BLS employment report, the stock market crashed and everybody's blaming the Japan carry trade for it. Let's continue. Still, reports of layoffs remained rare. On balance, wage growth was modest, while increase in non-labor input costs and selling prices ranged from slight to moderate. Consumer spending ticked down in most districts, having generally held steady during the prior reporting period. All right, consumer spending ticked down. That's a sign of slowing down of economy. Supports our base case. Auto sales continued to vary by district, with some noting increases in sales and other reporting slowing sales because of elevated interest rates and high vehicle prices. I don't know if you're keeping in track with the vehicle industry. It's not doing well, basically. There's a lot of cars. It almost reminds me of 2008 recession. There's a lot of cars not being sold and a lot of dealerships that are not doing well. Manufacturing activity declined in most districts, another sign of slowing down economy. And 2 districts noted that these declines were part of ongoing contractions in the sector. Manufacturing activity declined in most districts, and 2 districts noted that these declines were part of ongoing contractions in the sector. Residential construction and real estate activity were mixed, though most districts report indicated softer home sales. Softer home sales, another sign of a slowing economy. In other words, it's heading towards our base case of recession. Likewise, reports on commercial construction and real estate activity were mixed. District contacts generally expect economic activity to remain stable or to improve somewhat in the coming months, though contacts in 3 districts anticipated slight declines. I'm not going to go through the whole thing, but like I said, I'll leave a link on the description below if you want to go through all of these reports yourselves and all the Federal Reserve's district. So you got Atlanta, Richmond, Philadelphia. You can go through this one by one. And basically it's just going to say like if it's like declining on that area or if it's growing. All right, that is the Beige book. And we'll go over to the next report. So I got this chart by Zero Hedge. It's from a Zero Hedge article. And I first saw this chart in a George Gammon Rebel Capitalist video. So kudos to him. I don't know if any of you know, but he sparked basically my interest in economics, in macro, about 3 years ago. I've been following his channel now, Rebel Capitalist and George Gammon show. Before I was just totally a real estate guy. Yeah, like if you've been watching this channel, you know that Robert Kiyosaki sparked my love for real estate, even since when I was in the Philippines way back when I was like in my teens, like 2002 or 2003. And now I love economics too, and thank you to George Gammon. And yeah, I found this chart stunning because look at this. The green line is the construction jobs. And the red line is construction job openings. And usually they're pretty close to each other. Usually there's a small gap in between the red line and the green line. Because in some way, the construction jobs would follow the trend of construction job openings. It just makes sense. You know, if there's job openings, then there's going to be jobs, right? But look at the gap, the disparity here between construction job openings and construction jobs. It's the biggest gap in history. Now, I'm not saying they're messing with the numbers here. They're playing with the numbers. I'm not saying that. Maybe I am kind of saying that. But as you know, the BLS or the BS, the Bureau of Labor Statistics, has been doing very frequent revisions of their job numbers, and we even got 818,000 downward revision recently. I do have my tinfoil hatter conspiracy theorist moments, but I don't know, this gap between construction jobs and construction job openings seems kind of too big to me, and it doesn't seem right. And it's only been happening, I mean, we did have a few like large gaps spread between the green and red line in history, but nothing like what's been happening since 2021, 2022, and right now it's the biggest one. But like I said, we will wait for the BLS job report tomorrow. And click subscribe and hit the bell notification if you want to be notified of those reports. And now we're here at the Federal Reserve's website, the 10-year and 2-year Treasury spread. And as you can see, we've already had two small uninversion of the yield curve here, of the 10 and 2-year Treasury. And as you know, if you've been watching this channel, the 10-year and 2-year Treasury, when it uninverts, it just kind of gives you a head fake. It's not really it. It goes back to inversion and it uninverts again, but that's not it. But only until it does that full steep uninversion and rips through higher, and that's when, you know, we're headed for that gray bar, that recession. So we're just waiting for that. And if you've been watching the channel, you know our base case is a recession. And we are back at the Buffett indicator here. I like using longtermtrends.net. And from the last time we were in this website, the Buffett indicator is basically the ratio of the stock market to GDP. The stock market to GDP ratio. That's it. And we're using the Wilshire 5000 here as a proxy to the stock market. And last time it was only about 180%. The stock market is only about 180% of the GDP, and now it's 192% of the GDP. So it's saying here that the stock market is even in a higher bubble now, in a bigger bubble. It's like really nearly twice the size of the GDP. Alright guys, that's it for today. In conclusion, the Beige book is signaling slowing down of the economy, which supports our base case of a recession here at Learn Wealthy. The Buffett indicator is also showing a bigger stock market bubble from the last time we checked it, waiting for that bubble to pop. And the 2-year and treasury, the 2-year and 10-year treasury spread has already uninverted a few times, small uninversions, and went back to inverting again, which are only head fakes until we see that 2-year treasury drop fast, which will cause a bigger gap on the spread. And when it does that in a bull steepener, where the 2-year treasury falls down, which causes that uninversion, then we will really confirm that we are indeed headed for a hard landing and not a soft landing like what the Federal Reserve or the mainstream media is saying. So if you like that report or news, please follow me at Learn Wealthy. Please hit like. It will help me to make more of these videos. And please hit the bell notification and subscribe. I'll see you in the next video. Let's all learn wealthy together. I'll see you guys.